Hey, this is Mike Swanson of Wall Street Window. I want to give you a quick update on the markets and think a little bit big picture about what's going on. On Tuesday, the stock market took a very big hit and it's bounced back up, but there's still some reasons to be concerned. But at the same time, I think I can show you why it's going to take a while for a real bear market to develop here. Let's talk about the bad news first, and then we'll talk about the good news. So on the way the market's been trading this year is that the participation of stocks with the rally has diminished, meaning that there's been fewer stocks going up during as the S&P 500 has gone higher. Fewer and fewer stocks are doing all the work. In particular, four big cap stocks, I'll explain this in detail in a video on Sunday, are doing almost all the work. NVIDIA, Google, Facebook, Amazon, um, Microsoft. And this is hurting the technical indicators. The percentage of stocks above their 20-day, 50-day, and 200-day moving averages has is lower now than it was when it started the year, even though the stock market has gone up. Now, more troubling though is what happened on Tuesday. Tuesday saw such intense selling that 90% of the volume on the New York Stock Exchange and with the S&P 500 was to the downside. 90% sell volume. That's extreme, and it very rarely happens when the S&P 500 is within 5% of an all-time high or 52-week high. It's only happened about half a dozen times in the past 25 years. And every time it happened, within 12 months, the market was in a bear market. So, or at least a sizable 20% correction. We didn't have a bear market in 2016, for example, when this occurred then. So, and also there's fewer stocks making new 52-week highs last week when the market average did. Again, more evidence of the narrow participation in the rally. All these are things that often are warning signs that the market rally is unsustainable. And they were sprouting up last week, not the big downdraft of volume, but all these other things were happening already. And I made note of them Sunday. Watch out, because when this happens, the market can pull back. And bam, we got the pullback on Tuesday. But does this represent the ultimate top in the market or the start of a new bear market? And I want to suggest to you in this video that simple stock market trend analysis would indicate no. And the simplest way to do trend analysis is what I call stage analysis. And that's looking at the moving averages of the market, in particular the 150-day and 200-day moving average, to identify the primary trend. And when you're in a bull market, what happens is those moving averages trend up and act as support. Whenever the market tests them, it'll hold, it'll be a buying opportunity. And typically there are such tests at least once a year, often twice a year. When you're in a bear market, the opposite is happening. The market is trading below these moving averages, and those moving averages are going down. This was happening, in fact, in 2022. And you can get times where you're in an in-between phase. I call it a stage one base, where things are going sideways. It's more often you see that individual stocks, individual sectors, than you do the S&P 500 or the NASDAQ itself. Stocks can stay in that stage one, individual stocks and individual sectors, for quite some time. So where are we now? And this is the important implication. Well, even with Tuesday's drop, the market is way elevated above its 150-day, 200-day moving averages. That's the red line and the green line in the chart. It's also remains above its 50-day moving average. Now, I fully believe, and I said this Sunday, that we could easily see the S&P 500 test that 50-day moving average within the next couple of weeks or the next couple of months, even. And that I thought, then still do, that we got a little pause the first 2 weeks of the year, and then a breakout. And that little pause was worrying people, but I just thought, oh, it's a little pause. Don't worry about it, and it turned into one. This action now, though, with the way the market participation has been so narrow, and then the hit Tuesday suggests to me that we could get more than a simple 2 or 3 week pause here, but one that could last for weeks or months and see a retest of the 50-day moving average, the blue line in the chart. And then I'd have to evaluate things from there. Now, as far as shifting into a bear market, to do that would take a stage 3 topping phase. So the bear market's not going to start here with the stock market just peaking out one day and then going into some sort of collapse from then on. Instead, it would happen with an increase of overall stock market volatility. That's what characterizes stage 3. You'd see a test of that 50-day and a bounce back up to new highs, and a test of the 150-day bounce back up to new highs. This sort of thing would go on for months. It happened in March or the summer 2000 with the stock market. It happened in 2007 from August to December. And that's how you'd exit the stage 2, where there's a good 45-degree angle trend, and then things get choppy, and this choppy thing can last for months, all summer, going maybe even all year. And then that would be what precedes the coming of a new bear market in this situation. Either that or what happened in 2022, which was a pronounced deterioration in the internals of the market that didn't just go on for 6 weeks, is what we've seen so far, but it lasted for 10 months while the stock market went up. And it was a huge warning sign that this is going to end and end with a new, a bear market coming. And it did come. So, in other words, a simple way to put this all is that, this drop Tuesday, it's not the start of a new bear market. It would take time of more negative market action, months and months and months of market action to set the stage for a new bear market. If we're in a stage 3, if that's what's coming, it's going to be tough to make money trade, buy, hold S&P 500. Instead, you'll be having to focus on trading opportunities to select stocks that just keep going up, even though we're in a choppy, churning time. So these are the different scenarios that we could be facing. It's really two: a sideways phase, a test of the 50-day moving average, and then hey, those interest rates come, we take off. Or that can still happen, and then it's a fake rally, and then choppy times are coming. And we have to not so much predict which is going to happen, but realize that we're going to have these in our minds, and I'm going to keep this in my mind for the next months, and be watching the market for signs of which of these scenarios is going to unfold. So the situation has changed from where it was in January, where the market was just going up, 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 and up. As an extension of the October rally, and we got this hit Tuesday, and that hit is either a pause or start of choppy times for most of the rest of the year. So either way, I don't feel like in a hurry to go out and buy SPY or triple Qs. Focus on individual trading setups, individual stocks, and we'll watch the structure of the market and how these things unfold going forward. And I'll be talking with you later. If you like this type of analysis, hit the like button. If you want to get my next video from YouTube and you're not a subscriber yet to the channel, hit subscribe, hit the bell next to that, and then YouTube will send you an alert as soon as that next video is put up. And Who am I? So I run the website Wall Street Window. I've been trading the market since 1999. For 3 years, I co-managed a hedge fund that beat out a couple thousand hedge funds during that time, as ranked by hedgefund.net. I put out weekly analysis of the markets, and you can get those reports completely for free by going in the description of this video. You'll find a link to subscribe. You click the link, you go subscribe, and then you'll get those email updates for free. And I think you'll get a lot out of them. I'm also the author of the book, Strategic Stock Trading, which you can find available on Amazon.com. And it goes more in depth into the concepts, particularly that stage analysis concepts that I just discussed now, because that's really a linchpin of trading. Successful trading, I believe, involves identifying the primary trend that's underlying the stock, the market, the ETF that you're looking to trade, and then using shorter term trends to find the entry points. And then you keep riding that until the primary trend comes to a change. The primary trend, as far as being bullish, has not really changed yet. But we got a warning sign that it could. We got to keep our eyes open and see how things unfold here, and always look at things in an objective manner. So that's the way I approach the markets. If you like that approach, again, you know what to do. And I'll be talking with you later.